guitar. Well, but hey, I want to say thank you for coming to the meeting tonight. Most of tonight, I know that many of you have told me sometimes you hear me talk too much, but most of the night is going to be Darwin. We got any hands for that? Claps for that? Yay! Okay. Without further ado, let's welcome Darwin.
What happened is the market was going up and up and up. Fannie Mae and Freddie Mac have their underwriting criteria, and the market was going up, and the debt was getting, loan to value was going lower and lower and lower because the values were going up so high. And stepping in to fill that gap were bridge lenders. The bridge lenders basically said, okay, we'll loan you money on the future value of this property. And so they were filling a gap, they were filling a need, and us as borrowers said, yes, we'll take the bridge loan because we want to buy the property. Somebody else is going to buy it if we don't. Well, because of that, that helped drive the prices up. That was only a benefit to the sellers because now they could get more money for the property because the bridge lenders were there. So we had to be real careful about what we bought. Then we had the correction in April. With rates went up and they popped up and treasuries popped up, and now all of a sudden it's just this tsunami that came in and hit everybody. And across the market, there are a lot of properties in a lot of trouble because of their bridge debt. We are not completely immune to that, is why we're going to talk about Frankfurt. It's really the only one that we have any struggle with, because we try and remain very conservative on our underwriting, make sure we're properly funded, everything else. So we're good on all of our properties. We don't have that problem, but there's a lot of them out there. I had a conversation with somebody today that told me that there is I'm going to watch my words carefully. There is an investment group, a investment club, mentoring group, something like that, that had a sponsor, we can call him a lead, that raised $125 million, bought 2,000 units, and they have failed. 2 of their properties went into foreclosure today. Were supposed to be sold at the courthouse steps. There are partners in those that hope that they get 50% of their money back. This is somebody that raised $125 million. Well known, very respected at the time. And this was not because of a debt problem, this was because of an operator problem. So that's one of the reasons why we do so much education, is so that you can understand all the numbers and look at the underwriting. I see these advertisements and these PPMs that come out all the time that say a 2x return or a 22% IRR, and then you go dig into that and there's no numbers to back any of that up. It's all, hey, I say it's going to do this, so it's going to do that. So I highly, highly warn you to make sure you understand the numbers, make sure that they go through the numbers with you. That's why we go through all of the numbers in our presentation so that you understand, and we can stress test that, which we do usually on those presentations, so you can see what the numbers do and things like that. So it is key, especially now, that you understand what you're investing in. I've got another question. Who's seen their stock portfolio hit? Okay. Is that slowing down? Okay, for those of you who saw it hit, put your hands back up. Does that slow, keep them up, keep them up, keep them up. Okay. Put them down if that is slowing your potential investing opportunities in real estate. Look at that, okay. At least half saw their stocks take a hit, and now they're saying, I can't get out of them, otherwise I'll capture my loss, so I won't put it into real estate or other alternatives, other investments, which is, in my mind, scary. Personally, I've got, let's see here, maybe $10,000 in the stock market total. I hate it. It's real estate is the best alternative. I was having a discussion with one of our somebody we're associated with, and the market took a downturn. We said that prices dropped 5 to 15% over the last few months. Now, that's just because the prices dropped. Did values drop? Did
Would you, because I know they don't sound counterintuitive, but there is a major difference between price drops and value.
Okay, yes.
Please expand.
Okay, that's what I was trying to say is the values, okay. NOI keeps on going up. Does my screen work, Mo? Let's see here. This is what I drew earlier because cash flow keeps on going up, okay? NOI keeps going up. Values were going up a little bit faster than they should have, and now there's this dip, okay? So that's in the prices. Did the value go down? No, as Julian was saying, the value didn't go down, just the prices went down because of the debt you can't get, or can or cannot get. So that's going to come back up and go back and equalize. So right now we're down here in this trough, okay? And we're in that trough. I am not an artist. Down in that trough is where we are now. So we don't really want to sell right now unless you have to. And there are some people that have to. And if they're caught with my dad used to call them neutron loans. Anybody know what a neutron bomb is? Okay. A neutron bomb kills all the people but leaves the buildings. And that's what we don't want to have happen. That's what we don't want to have happen to you guys. Is we want to make sure that you guys are protected as well as the asset. So that's our number one goal, is to protect everybody. So there's that little dip, and that's where we are right now. So even though the prices went down, the value didn't go down, our NOI is still going up. So that's why you ride through these waves. It'll go like that. You don't want to sell. That's why you can never time the market. It is so hard to time the market that you don't even try. So values did not go down, but prices have gone down. And that's only because of the debt. That will go probably another year to 2 years is before we come out of that. From the tip to the trough is usually about 2 years. Okay? So that'll be coming back up. I was just reading a report regarding those of you, I look around the room and there's some people that remember the 70s and early 80s and how high interest rates got there, how high inflation got. And I'm not an economist. And I think that what happened then is different than what's happening now. I hate to agree with some people that say, because here's the whole thing. We are in a recession, 2 down quarters, right? Okay, but it's not as bad as the other time because unemployment side. This is a supply side dip, not an actual complete recession. So there's still opportunities out there, and I still think you need to invest. Even if you have money in the stock market, are you going to wait for that to go back up before you sell it and invest in real estate? Or are you going to, what goes up the most during high inflation times? Real estate? Who remembers 1980? How did the property values go then? Garrett, you weren't born then. He's like, yeah. What did properties do in the late 70s, early 80s?
Owed more than they were worth.
You owed more than they were worth. Yep, and interest rates went high, but inflation also kept that up. And inflation, the biggest benefit for being in apartments is when rents are going up fast, you want shorter term leases. So you can capture that. Leases, for example, on a commercial property like this can be anywhere on a large lease, anywhere from 3 to 5 years. Well, you can't raise rents very much. So if the market's going down, you're better off in a building like this where the rents don't go down. Whereas if the rents are going down in apartments, that's going to happen more often. But there's a lot of other benefits. I don't need to go into all those. What else? Let's see here. How do I turn off? Okay, I want to talk about the first off, any questions on any of those items? Any comments? I'm not the smartest guy in the room. Yes, sir. Yes, ma'am.
Why do we not want to buy while it's down?
Why do we not want to buy when it's down?
Are we going to buy during
We absolutely want to buy while it's down. The problem is when it dipped like that, here's the whole thing. The boat's rocking. We can't make heads or tails on what's going to happen. Is there a bigger storm coming? Is it going to level off? What's going to happen? So from April until now, it's pretty much pencils down because we don't know what's happening. And the whole idea is you need the stability in the market to be able to predict what you're going to do. Just like investing in any businesses or opening a new store or something like that. You want an idea of what's going to be happening in the future. So stability is the most important thing for planning, to know what you're going to do. So everybody put their pencils down, said, we don't know what we're going to do. We got to see what the debt market's going to do, what interest rate caps are going to do. And now that we've had some settling about that, now it's time that we can say, okay, just like COVID, just like everything else, it's not as bad as we thought it was going to be. But you pull back and say, what's going to happen? Yes, sir, you had a question?
So how much are you dollar cost averaging into the stocks? Are you doing like 1% of your portfolio? Or?
Dollar cost averaging on stocks. I have $10,000 in the stock market. And of that, most of it is worthless options. You know what, I swing for the fences on that. I think the stock market is gambling in my mind. I hate it. Yes, sir.
We are in Amber Trails, and we're quite new in this one. So do you have any more insight into it? Have seen the reports, but what do you expect?
Any more insight on Amber Trails? Brian, grab a mic. Amber Trails is a new purchase, and it has a bridge loan with floating rate loan. And we've got an interest rate cap on that one also. And we're still early in the process, but Brian, go ahead and talk about Amber Trails.
Yeah, I mean, bottom line is they're both doing well. They're both doing according to plan. But as Darwin said, we're really almost just barely 3 months into that. So the only thing that has been a little bit differently than what we thought is that we're actually doing much better on renewals of leases, as opposed to the plan on both of those properties was to actually flush the property pretty good and get new people in there. We could rehab the units, get new people in there to higher lease. I just shared some news information this morning. I talked about my staff meeting this morning. Those are two examples of properties that we're actually getting more in renewals than we're getting in new leases. So, but that bodes well, because what does that mean? It means that I'm not having to spend, again, in those cases, anywhere from $5,000 to $10,000 in CapEx and still raising your income.
If I remember the numbers right, new leases are $140,000 trade out. I mean, $140 trade out, and renewals are $153.
Well, that was on one property. On specifically on Amber Trails, it's closer to renewals are closer to $190 and new leases are $125. So there's actually a bigger gap at Amber Creek and Trails Place than it was at the property we talked about.
Okay, very nice, very nice. Yes, sir.
A quick question. You mentioned your debt bubble, your bridge loan bubble. What do you think the time frame is on that as far as when those will be popping, and for how long?
Okay, it already popped is why it went down. Okay, and right now bridge lenders, we're out, we're done. So that's part of the problem. I was talking with one buyer. They shopped a loan to 70 different banks and they all turned them down. Okay, so bridge lenders are out. Fannie and Freddie are still around, but they've got very strict guidelines on what they'll underwrite. So you're only talking about a 50, maybe 60% loan to cost, which means a whole lot more money down. You're utilizing less leverage, which lowers your overall yield. Leverage increases your yield, usually, but because you have to put so much more down, you don't have that benefit of additional leverage. So kind of a play right now is you have to put more money down, but you'll be able to do a refinance and pull that money out as soon as that comes back above that line. where the dip came down and go back up, we'll be able to refinance and do a supplemental or something along those lines to go ahead and get more money back. So we're looking at more money down, but then a larger amount of refinance proceeds when we refinance in what we budget is 3 years, but it could be 2 to 3 years.
On that group that's getting foreclosed, do you think the bank is getting out of those clean? So I guess if the people are getting half of their money back, if they foreclose, then the bank should be made whole, right?
Who gets paid first?
Well, the bank does, right? So, but the bank isn't yet underwater. I guess, so like if when the property starts getting to where the bank isn't going to get their money back, when would they start looking at doing a financing to not take the property back? You know what I mean? Does that make sense?
As far as doing a short sale or?
Well, maybe a short sale or something, yeah, I guess.
Okay.
Or giving a better interest rate so they can hold on to it, or is there not enough foreclosures for them to consider doing that?
I'm not exactly clear on exactly how to answer that one. But let me change it around a little bit. Who's willing to guarantee a loan on a property? There's 2 of us. 2 of us. Okay? I have no problem guaranteeing debt on a property. I'm comfortable with it, and here's the reason why. Especially right now. Let's just say you take a $10 million property. Well, right now, the max loan you can get is $6 million, okay? And that means you're coming out of pocket with $4 million. So if we buy, I do a personal guarantee on that loan. I'm guaranteeing that the bank is going to get $6 million plus their interest back. And then we raise $4 million. Before I'm at risk, number 1, the cash flow has to drop where you cannot make the mortgage payment. What's happening with the cash flow? It's still on a steady climb up. So we're not hurt on that. So income has to go down is the first thing, first domino to fall. So if by some reason income does drop. Now, the biggest reason income drops is poor performance by the sponsor. So that's where a lot of the blame would lie. So the income drops. And then you have to say, okay, we're not willing to put any more money in. So if you've got a $10 million property and you've invested $4 million, okay, let's just say every person in this room invested $50,000 in that deal. It's about right, okay? And we said, bad news, we're going to lose the property, okay? But we can go ahead and hold on to it if we go ahead and we need an extra $20,000 a month to pay the debt service. Okay, first and foremost, income needs to go down below your break even for your expenses and your debt service. Well, the next thing that happens is operators will stop paying expenses or cut back on those, which is a horrible thing. That's just a spiral downhill. But they can do that and still make a mortgage payment. Then it needs to go down where it's even worse, and we go through and say, okay, look guys, we can't make the debt service, we can't pay the expenses, but if we want to hold on to this, you guys all have $50,000 invested. I want everybody to kick in $100 a month so that we can break even. Would you kick in $100 a month to save your $50,000 investment? Okay. That's the next alternative. Okay. The next alternative after that is you're renegotiating with the bank. What happens to a bank if they've got a bad loan? Any bankers in here? Because I'm going to get the wrong terminology. And again, I'm not an expert on this. I'm just telling you in layman's terms, very layman's terms, is when a bank has a loan that's a performing loan, it's perfectly fine. If that is a non-performing loan, the bank has to put up extra reserves with the Fed. Is that right? Okay. So that costs them money out of pocket. They don't want a bad loan. What they're willing to do is negotiate that loan. They're saying, wait a minute, we don't want this loan back. We remember what happened in the 80s, and we took all these back, and it was a daisy chain, and everything foreclosed. And even the Fed would say, okay, you can go ahead and you don't have to foreclose. We'll loosen our standards, things like that, because we do not want a savings and loan disaster again. So the next thing that happens is you need to have a bank that's not willing to work with you. Okay? So all of these things need to happen, and then it gets if all those things happen and everybody says, forget it, we're over, it's done, a meteor hit the earth and I'm not going to put more money into it, and the bank decides that they're not going to redo the loan and they're going to foreclose on you. Now they foreclose on you. And on a $6 million loan, it might be, say, $7 million with fees and interest and everything else. Well, now they take that loan back, and if they sell it for less than $7 million, that's what I'm on a guarantee for. So if for some reason they take it back for $7 million, and at the courthouse somebody doesn't buy it for $7 million, anybody been to a courthouse auction? Okay. They basically, if you have, let's just take that same example, is the trustee says, okay, we're foreclosed, I don't know the right terminology, but bottom line is we're foreclosing on this property, the loan is $7 million. Does anybody want to bid on buying that at $7 million? Okay? And the first bid will be from the bank. They say, okay, we're going to buy that for $7 million. Now, if anybody else bids on it, $7,001,001, which they pretty much have to pay cash right then, so it's a little bit of a different thing. Then that bank gets made whole. They get their $7 million, it's over, it's done. If they sell it for, there's no takers, they then foreclose on it, they take the property back. After they get the property back, then they put it on the market, and then whatever they get under $7 million, you're liable for. Okay, all of these bad things have to happen. Really, really bad, horrible things before that loan guarantee would kick in, okay? Now, if you're a loan guarantor on one of the properties, you get extra ownership. You make extra money. You get extra write-offs, okay? Let me ask you that. Going through all that, there was 2 people that would be willing to guarantee a loan. Is there any more? Now you, I mean, but before there was only me and Brian that would guarantee it.
But you didn't distinguish between recourse and non-recourse.
Well, that was all recourse. Yeah, you're right. That was all based on.
People would guarantee a non-recourse loan.
Okay, if you guarantee it, okay, did anybody know the difference? Recourse and non-recourse. My example was a recourse loan. That means I'm personally liable for it, okay? On a non-recourse loan, that means that there's not personal liability except for what they call bad boy provisions, okay? And that means you commit fraud, theft, something like that will convert it to a full recourse. In a non-recourse scenario, it gets down to that position, the bank says, hey, we're foreclosing on it, and as long as you don't fight them on it, it still stays non-recourse, and you say, okay, here's the keys back. And that non-recourse is Fannie Mae, Freddie Mac, HUD, and some bank loans and insurance company loans, things like that. So there's even less risk on a non-recourse loan, okay? So just giving you a little education on that. But now that you understand all that whole process, there was, I don't know, 8 or 9 more people that would be willing to guarantee loans because they understand that process. That's, of course, if you believe me. Yes, sir.
Do potential future Fed rate hikes have an influence on your evaluation of upcoming properties?
Yes, absolutely. Here's the way you need to underwrite it right now, which is really hard to make properties make sense. Cap rates were at about 3.5 on a good quality asset, and you could get loans at 3 to 3.5% interest, okay, which means you're not making a tremendous amount on the spread. But now cap rates bumped up to 4.5% because the rate hikes came in there and interest rates got higher. The problem is most things are still a variable rate mortgage. And because of that, you need to underwrite to whatever your current rate on your loan is, plus your rate cap. Okay, a rate cap is an insurance policy that says, okay, your rate's at 4% right now, the bank will say, hey, basically, bottom line, we don't trust you to make the payment if it goes up above 6%, so you have to buy an insurance policy that pays us or reimburses you if the payment goes above 6%. Well, a lot of the, this is a great conversation, is so basically your payments can still go up 50% from 4% to 6%, but anything over that insurance pays for. So you have to underwrite to your rate cap amount. So now you're looking at 4.5 caps with 5.5% interest rates with your cap, or 6. That doesn't make sense at all. And that's the reason why the prices went down, is because now they're underwriting saying, we got to take into account this interest rate risk. Another thing about insurance policies, those rate cap insurance is very, very interesting. If you would have bought it a year ago, a rate cap on, let's just say a $10 million loan, it might have cost you $100,000 for a 2% rate increase cost. Say $100,000 on a $10 million loan. That policy right now might be $1.1 million. Okay? So a lot of people that are still buying saying, oh, I can get this deal, and they start underwriting it, and then the lender says, oh, you got to buy this rate cap. Oh, and that's $1 million. Now that shoots you right in the foot. Okay, $10 million property, I got to spend $1 million on a rate cap? Conversely, if you bought that a year ago for $100,000, that's an insurance policy. It's a negotiable instrument, meaning that there is value to that insurance policy. So you could sell that insurance policy. If it was $100,000 then and now it's $1 million, you could probably sell it for $800,000. So you actually made money on that insurance policy. But you got to buy it now, it's going to be much more expensive. Okay.
Now, can you explain what changed?
What changed?
Why did it?
The risk profile. There's companies that underwrite that risk, just like any insurance company, they underwrite the risk.
What's now more risky than a year ago?
Because rates are going up. There was stability in the market a year ago. Now there was instability in the market. Okay, I'm getting waved off on questions, so let me jump into this. Part of the, you all saw the email regarding 10% interest, right? Here's what we're doing. That debt bomb that I said, we only have one property with a problem on it. It's Frankfurt, okay? Frankfurt, back in February, we'll round down and say that the value of Frankfurt was $50 million, $50 million in January, okay? We were waiting for our prepayment penalty to burn off for 18 months, because we have prepayment on the loan. We were waiting for that to burn off so that we didn't have to pay that, and we refinance it. Well, it was kind of a gamble. We didn't think that rates would go up so quick and so fast. So we were waiting on that. Well, then April hit. And we said, okay, we've got a problem. Our payment has gone up by $60,000 on that property, okay, because of the interest rates going up. We're at our market cap. It's not going to go up any more than that. But we're not a big fan of this particular lender, okay? When we bought the property, is anybody who's an investor in Frankfurt? Okay, good. When we bought the property, we put it under contract at 38% occupied. We took over management. Our great management team got that at closing up to 88% occupied. Okay, so that blew our numbers. I was projecting at least a year to lease it up to that level. And so they did great on getting that going. But when we were negotiating the deal and putting the loan in place, they were looking at it going 38% occupied. So we couldn't get, it's not stabilized. We couldn't get Fannie Mae, Freddie Mac debt. We had to have a bridge loan. The lenders, most of them didn't like it because there was not a debt yield or debt coverage ratio. So we went to the best lenders we could, and the deal that we got, how much did we pay for the property, Julian? 37 million. We paid 37 million for it. We ended up getting these are real rough numbers, so I apologize if I'm off. Bottom line, with our prepayment penalty, is $33 million as far as our loan payoff. Okay, it's like a 28% $8 million first loan, another $3.5 million second, plus prepayment penalties to pay it off right now. So we would need to refinance and pull out $33 million to pay off that loan. Well, with a $50 million valuation, that's a 66% loan, which in a stable market we should be able to get. Not in a stable market. So we have to, the best loan that we found is a non-recourse loan, and it is for $26 million, 25.9 actually, $26 million loan. So we're short on paying off our debt at $33 million by $7 million. The way that that's set up is we've got our first loan and then a mezzanine loan. That mezzanine loan is at what percentage interest rate? Do you know off the top of your head? 13. About 13%. That sucks. Okay, that hurts. Our payment has gone up so much that it's erasing the possibility of paying distributions. Okay? Because that payment went up so much. We also don't really like this lender. About a week before we were closing, if you recall, the seller had about 20 units that were Airbnb units. And if you remember when we put it under contract, even though it was a brand new property and 38% occupied, they had 0 available units to lease. How is that possible? Because they didn't punch out all the units, they didn't get everything done, there was partnership infighting, and because of that, they didn't get everything done, there was no units available to lease. So the seller, one of the sellers, did Airbnb units to try and jack up the collections. Well, he did that. Well, our lender, when he saw the rent roll, he said, "What is this?" And he said, "Wait a minute, that's a short-term rental property. So that's operating more like a hotel, so we're going to jack you up on your rate." They raised our interest rate 1/4 point because of that. And they had us over a barrel. We were a week before closing. We had to get it closed. And, what do? You got to basically take it. And so they bumped our interest rate up. They're very aggressive. We decided, well, let's just go ahead and pay off the mezzanine loan. It's $3.5 million. Call the lender, and the lender says, "Oh, that's fine. You can go ahead and pay that off, but you got to get approval of the first trust deed lender to go ahead and do that." First trust deed lender is not giving approval. Okay, so we don't like this lender, bottom line. So we're going to pay that loan off. So we're going to refinance that property at $26 million, but that means we're $7 million short. So for the Frankfurt partners, cash flow is already going down to 0 because of the higher interest rate. So what we're going to do is refinance, and we're going to go ahead and give that benefit. We're going to raise $7 million on partner loans, secured by the partnership, not by the property. We can't secure it by the property because that would be a violation of the loan terms. So this is just a internal partnership loan, and you can invest $50,000 minimum, but we're going to pay 10% interest with monthly payments. So this is a cash flow play. That's all it is. And the example I was using earlier on all the different bad things that could happen, and going back to it, well, now we're in a position we can raise $7 million, get the refinance done, and put us back into a positive cash flow position, and then pay that off when the market stabilizes again in between 1.5 years, and we actually put 3 years in our loan documents. So anybody that's missing cash flow, which a lot of properties are hit, even Grant Cardone had to lower his distributions on his properties. So this gives you the opportunity to have good cash flow going through this. So here's a question: is 10% interest a good interest rate? What are you getting on your savings accounts? What about dividends on stocks? What about stock prices? So this is a way to give you some stability and protection, because those partner loans are paid off before we pay anything to the equity people that already put in $8 million. And you got to remember, the value is $50 million. $33 million was our total loan. including payoff, we're still only going to have a $33 million loan. So it doesn't hurt the Frankfurt partners at all. It just puts the property in a better position. Okay. Is anybody interested in investing? Yes, sir.
I'm interested, yes, but is it a month-to-month payment or is it a 12-month guarantee?
We're going to pay it out monthly.
Okay.
It's a 10% annual interest rate paid out monthly, just like a loan. So now you're basically becoming the bank.
Right.
So you got better security than you would as an investor.
Are you paying principal and interest?
Interest only on it. Yes, sir.
So at if you invest $100,000, $1,000 a month, is there any other?
$100,000 would be $10,000 for the year, so it would be $833. Yeah.
Divided by 12.
I just want to make sure we were.
Is there anything else involved in that as far as fees or?
Any other fees or anything else that, no, that it's just like a loan, like you're doing a loan to anybody else. 10% interest, that's it. Yeah, and we're not taking anything out, no override, no nothing. That's just a flat amount for interest rate. Okay?
And you expect that to be for 1.5 to 2 years?
We are putting in our paperwork 3 years to get through that. I really anticipate 16 to 18 months till we get through this, because here's the whole thing. We're paying 10% interest. Myself and all the other partners in Frankfurt want to get that paid off and get back down to a reasonable interest rate. So we want to do that as soon as we possibly can. Yes, sir.
I think that might have been the question of what would be the event that I get my capital back?
When the market stabilizes and we refinance. Refinance or sell, which both are possibilities, but like I said, it's a legacy asset. We'd like to hold it a long time. Refinance it is the best option. Yes, sir.
What is the interest rate on $26 million? Is it non-recourse loan?
Okay, our new loan is $25,900,000. It's at 4.4% interest, fixed for 5 years. We could have went at 4.6 for 7 years, but I want to get this paid off in 5 anyway, so. Okay.
So first, lien holder would be the bank.
Bank is the first lien holder.
$7 million investors, debt holders.
Okay.
Second line.
Okay, I want to make sure to be real clear. It is not secured by the property. Okay? It is only secured by the partnership. And technically, I'm walking a fine line on that anyway, because we're not supposed to have additional debt. Okay, so we're walking a fine line on that anyway. So I want to make sure this is not it's not secured by the real estate. These are partnership loans is all they are.
So I'm invested in Frankfurt Station,
Mhm.
and I'm really interested in this as well, holding a debt. So this property bought for $37 million.
Mhm.
Our all-in cost was $40 million, which is $196 a door.
Mm-hmm.
Current value of the property was $54 million. Since then, it went down to $45 million. So we are still.
No. Okay, let me correct one thing there, because Julian made sure that I say that. The amount that we could sell it for right now because of the market is 45. It's still worth over $50 million, which is why we don't want to sell it for $45 million now. We could sell it and the partners would get 40% return, but there's still $5 million plus on the table.
And that's the point I want to make across, that equity holders are safe, and so is the debt holder, $7 million are safe, because we are still out of the money.
Correct. Equity holders are still safe because they still have the equity in the property, and the partner loan people are still safe because it's still the same amount of loan debt that we have right now, and so we still have that same amount of equity in the property.
Great. Thank you.
Yes, sir.
Yes. What's the current monthly NOI, and how does it compare with this new debt service?
Okay, our monthly NOI, correct me if I'm wrong. I want to say at Frankfurt, 150, and our payment has now went up to 180.
Okay, but the new payment?
The new payment will be about 150.
Oh, okay, so just about break even.
About break even, exactly. Is that correct?
That is correct. But again, we would anticipate making continuous.
But,
for example, this.
And the other thing is our property management team thinks that they're going to get income up another $20,000 over the next few months.
And we're up 14 this month.
And you're at 14 so far. Okay. So we're working on that to get that even higher. Yes, sir.
So if you get this through, are you thinking you're going to be able to start distributions on Frankfurt in the next year?
So if we get, to repeat the question, so if we get this done, do you think we're going to be able to do distributions in the next year? I am hoping, yes. See, and part of the thought process on this is, hey, I'm an investor in Frankfurt. I've been getting cash flow. That cash flow, no matter what right now, because of the higher payment, is going to go away. But I still want cash flow, and I still got money in the bank. So I can go ahead and reinvest in the property, get good cash flow, actually better than you were getting beforehand, and put the property on a nice stable trajectory so that they can, so that way you can have that big gain later on and get cash flow now.
Those cash flow now is what you're saying.
Cash flow now for the partner loans, yes. Yeah, because I was thinking about you specifically on that because you live off of the cash flow. And if the cash flow is going down on that property, you might want to go ahead and put something in because it's better return. I think our cash flow that we were paying out was less than 5% already. Okay, so now if you're reinvesting on that, putting a little bit more money in there, and you're getting 10% interest, you're actually doing better than you would have done originally. Now you don't have the equity, but yes, sir. Exactly. The big deal is it fixes the debt issue because now we've got a stable 4.4% interest rate loan for the next 5 years and puts us in a nice, solid, safe position. And here's the whole thing. There are so many people going through this same exercise right now in the market. Everybody that has bridge loans over the last couple of years has most of them have similar issues. Now we're well capitalized. Really, if we said, forget it, we can't do it, we still got over $1 million in the bank that we can go ahead and draw off of and still be okay even with the negative cash flow. But that is not what's best for the property. We always look at what's best for the investor, which is usually what's best for the property. And that's what this is. And we, in our effort to be transparent, tell you the good, the bad, and the ugly. And that's, I was bragging to some people, actually I brag all the time about the partners that we have. Not bragging on me, I'm bragging on you guys. Because you're all very astute business people and you understand that there's rough waters in business sometime. You understand that it's how you address those problems that is the most important thing. So we want to be transparent, tell you, hey, here's the issue that we have, and here's our solution, and here's how we're moving ahead. And a lot of people, like the guy that's getting foreclosed on, he was just keeping his head in the sand and not communicating and not trying to work out solutions. And that's what happens when you don't try and come up with solutions, you get foreclosed on. Not us. We're going to make sure we're proactive on this. Yes, sir.
And lender is not requiring us to buy the cap.
And the lender is not, no, because it's a fixed rate loan. It's a fixed rate loan, so we do not need to buy a cap.
Interest only
Interest only.
for 5 years.
Interest only between 2 to 3 years. I've seen one time, I think the original term sheet said 5 years, interest only. But another email follow-up, I think, showed 2 years of interest only. But we want to do something within the next 2 to 3 years anyway.
You're talking about the $27 million?
The new $26 million loan, yes. No, over our blended interest rate is going to go down to like 5.5% interest as a blended interest rate, because $26 million is the first at 4.4 and then another 7 at 10%. Somebody that wants to be fishing on math, it's about 5.5%.
The lenders.
Okay, the $7 million that we're going to get, we have to pay off our loan at $33 million. $7 million of that is going to pay that off. The other $26 million is coming from our new debt.
And that reduces your loan service, which gives you more money to pay to those.
And I'm repeating the question. So that does give a lower payment for our mortgage, which allows us to pay the interest on that, because our payment is actually going to go from $180,000 to $153,000. So we actually save money on that, but our NOI is 150, 100 going 155, 160. So that puts us at even paying that debt service puts us back even, is what it does, while we're still continuing to. The biggest thing we have on that is the loss to lease, because we did a lease up and with lower rates. So now we're doing that, renewing the leases. So that is a big part of it, is burning off those loss to leases and raising the rents, which will increase our income. Yes, okay, so the benefit, to repeat what he said, is, oh, I know, is that the mezzanine loan that we have right now is going from the 13, 14% down to 10%. But our first loan is going from about 7% now down to 4.4. Okay, because both of them are, we're going to save money on both of them, yes. Even paying 10% interest, we're going to save money on both of them. Any chance the proceeds from Southwest sale can go into this? When is Southwest closing?
19th. Yeah, the 19th.
Yes, absolutely. Yes, the proceeds from Southwest can be reinvested into that.
And Brazos, 2405.
Yeah, all the other properties as well. Here's the other thing, we're not going to close that for another 45 days or so, but we need to get the commitments in now. As a matter of fact, we'll probably have signed commitments from everybody so that we know how much we're going to get, so you can leave it wherever it is until we get closer to the date of requesting those funds. So we've got other plans.
And Darwin, I have the note already prepared.
Yeah.
For anybody who wants to see it, and it's a very simple note, simple interest, so anybody
Yeah,
wants
so
to see
Julian's got that paperwork if you want to see it now. Yeah, real simple thing. Do we think about raising that through the existing partners before allowing other people? And why did it, well, here's the whole thing. I'm opening it up to everybody because the partners still have that option. It's not a first option. I don't think that, here's the whole thing. What's best for the property and what's best for the investor? We have to get the refinance done, so we have to raise the money. If I go back just to the existing partners, we may be short. So I'm just saying here, if the partners want to be involved in it, great. There's a lot of room in there for existing partners and new partners. So and not only that, it also gets me the opportunity to explain everything to everybody rather than just talking to the Frankfurt partners by themselves. Because this is a learning experience. For those of you who aren't in Frankfurt, you can see how we're dealing with this. So if you're in any other deals, you can see how they're doing it too, or you can have other comments or thoughts and saying, whatever. If you're interested, make sure you just contact Garrett or Julian. And like I said, they've got the paperwork here if you want to take a copy of it, look at it, have your attorney look at it, however you want to do it. If you want to get a copy of that now, you can. And again, it's a commitment right now, just so that we know how much it is to make sure that we have enough and that we're full, or that if we have to stop taking any more people.
So we just go through the same way we've gone through other parts.
Exactly. Well, this one's a little bit different because it's not on the portal. But so it's just direct paperwork with them. And that's easy. It can be faxed, scanned, emailed. It's simple.
You could even do it tonight.
You can even do it tonight. Yeah. Yep. If you want to make dang sure you're in there first, go for it. All right. Thank you so much for coming. Talk to Garrett and Julian if you're interested in the partner loans. Text to Invest at Darwin German to get on that VIP list to hear about all the crazy crap. And thank you all for coming.